The market, my friends, is not just ringing alarm bells, it is practically screaming fire, and yet I look around and it seems like everyone is wearing noise-canceling headphones. It's absolutely baffling. Just recently, on May 13th, the U.S. Treasury auctioned 30-year bonds at a yield exceeding 5%, a level we haven't seen since 2007. And as if that was enough to make you sit up and pay attention, a mere 6 days later, that yield climbed even higher. Bank of America's chief strategist, a guy I usually listen to with a healthy dose of skepticism, has dubbed a 5% yield the Maginot Line. For those of you who aren't history buffs, the Maginot Line was supposed to be France's impenetrable defense against a German invasion in World War II. We all know how that ended not well. And now, this financial Maginot Line, this supposed barrier, has been utterly annihilated. BofA, in their characteristic dramatic flair, is saying the door to doom has opened. While doom might be a tad hyperbolic for my taste, the accuracy of their assessment is chillingly plausible, and the hits just keep on coming. Well, this isn't an isolated incident. Japan's 30-year bond yield just hit its highest point in history. The UK's 30-year bond is at its peak since 1998, and Germany's 10-year bond, a 15-year high. Now, a bond blip in one country? We can probably shrug that off, but this many blips happening simultaneously across the globe, that's not a blip, that's a blinking neon sign screaming, pay attention. Every previous time we've navigated a similar economic storm where one country was facing turmoil, the others remained relatively stable. This meant capital always had a safe harbor to run to. Not this time. This time, it feels different, more interconnected, more precarious. Here's the kicker. The stock market is utterly ignoring this distress. The SP, bless its oblivious heart, just hit fresh record highs. The bond market is bellowing, but the stock market is throwing a party. And let me tell you, they cannot both be right. In 3 blunt and brutal parts, I am going to lay out why the bond market is screaming, why the Federal Reserve is caught in an inescapable trap, why the stock market is dangerously detached from reality, and what as financially savvy individuals should be anticipating. So let's dive into part 1. The economic Maginot Line has been breached between September 2024 and December 2025. The Federal Reserve cut interest rates 6 separate times, a total of 175 basis points during that exact same period. The 30-year Treasury yield, in a move that defies all conventional economic wisdom, rose by nearly a full percentage point. Let's put this in perspective. In the previous 7 Fed cutting cycles, going all the way back to the 1980s, long-term Treasury yields were lower 100% of the time within months of the first cut. Not most of the time, not frequently, but every single time. This, my friends, is the first cycle in over 4 decades where that pattern has been shattered. The fundamental purpose of having a Federal Reserve, despite its massive downsides and the inherent inflation it brings, is its supposed ability to manipulate and stabilize the economy. To have a Fed with all its inflationary baggage, yet be utterly incapable of steering the economy when it is clearly in trouble, as we are now, is simply horrendous. So, when the Federal Reserve slashes rates but long-term borrowing costs refuse to budge, you've got a genuine, full-blown problem on your hands. Cutting interest rates to lower borrowing costs is the very mechanism that has defined central banking for the last century. If that mechanism is failing, then we are in uncharted and deeply unsettling territory. Let's quickly demystify how this all should work, because the inverse relationship between a bond's price and its yield can be a bit confusing. Many people, understandably, might not grasp the gravity of what is unfolding. Imagine the US government needs to raise some cash. They issue an IOU, a bond, for $100 and promise to pay the owner $5 in interest per year. That is a 5% yield. Now, these bonds can be traded on a secondary market. If demand for the bond is high, buyers will bid up its price, say to $125. That same $5 annual payout from the government now represents a lower yield, only 4% based on the new purchase price. Conversely, if demand is weak and buyers are only willing to pay $80 for a bond originally priced at $100, the yield for that new buyer jumps to 6.25%. So, when you see headlines screaming about yield spiking, what they really telling you is that if the US government were to issue new debt right now, they would be forced to offer significantly higher interest rates to entice lenders. And this isn't just a US phenomenon. The exact same unsettling pattern is unfolding across nearly every major central bank on Earth. The UK's 30-year gilt is at its highest yield since 1998. Japan's 30-year yield is at an all-time record going back to 1999. Germany's 10-year is at a 15-year high. A strategist at the National Bank of Canada just reported that average G7 yields collectively hit a 17-year high at the end of April. This isn't just an American problem, folks. It is rapidly becoming systemic. Now, I sincerely hope that BofA's door to doom rhetoric turns out to be more clickbait than reality. However, Bank of America's chief strategist is aggressively highlighting 3 historical instances where surging bond yields directly preceded major market crashes. Japan in 1989. Right before the Nikkei's monumental collapse and the start of what became known as their lost decades. The US in 1999, just before the dot-com bust. And China in 2007, right before their market experienced a significant downturn. Three major crashes, each preceded by strikingly similar fingerprints in the bond market. And those fingerprints are identical to what we are witnessing right now, with one crucial and frankly terrifying caveat historically. This doesn't play out across several systemically important economies at once. Usually it's a localized issue allowing investors to move their capital to safer havens. But this time, it is everywhere. We are seeing the traditional precursors to a major crash happening virtually everywhere simultaneously. This significantly limits investors' ability to find safety, making the situation far more precarious. The bad news is, while all this is happening, the Fed is trapped. Its ability to steer the economy severely compromised. Cutting interest rates right now wouldn't pull yields back down. In fact, it would likely exacerbate the problem. Bond buyers are already signaling to the market that they don't trust. They receive adequate long-term returns at current rates. Cheaper money, a consequence of rate cuts, would only mean even lower returns on the risk they retaking. Moreover, such a move would almost certainly cause inflation to run even hotter. All of this would make already less attractive bonds even less attractive. So they retrapped. The critical question then becomes, how did the Fed stumble into this trap? Because it has a clear cause, and that cause is our second alarm bell. Welcome to part 2, the inflation trap Fay, and it is closing fast just 2 months ago, before the recent geopolitical flare-ups. Like the strike on Iran, US inflation had actually eased all the way down to 2.4%. The Fed was on what looked like easy street. Things seemed promising, and the bond market was even starting to breathe a sigh of relief, but not anymore. On May 12th, the Bureau of Labor Statistics reported that the Consumer Price Index (CPI) has already surged to 3.8% year-over-year for April. That is the highest reading since May 2023. In a mere 2 months, inflation has jumped a staggering 1.4 percentage points. And to compound the misery, producer prices (PPI), which reflect the increase in costs for businesses and eventually lead to higher consumer prices, hit 6% year-over-year. That's the fastest increase since late 2022. When PPI goes up, consumer prices inevitably follow, so people should brace themselves for even higher prices in the next 3 to 6 months. Inflation is far from done accelerating. This acceleration, by the way, will only amplify the bad news for the first time in 3 years. The average American is now losing ground in real terms. Wages adjusted for inflation have turned negative. Workers' take-home pay, again adjusted for the relentless march of inflation, fell 0.3% over the last year and a sharp 0.5% in April alone. So not only is the bond market demanding higher rates due to growing concerns about the stability of the U.S. economy, but the Fed is also paralyzed. They can cut rates to stimulate the economy because inflation has come roaring back and has already outpaced wage growth. The root cause of this inflationary surge isn't exactly a mystery, folks. Energy prices alone are up 17.9% year-over-year. Gasoline has spiked 28.4%. And oil is hovering above $105 a barrel as I speak. And let's not forget the Strait of Hormuz, through which roughly 20% of the world's oil passes, is still not fully operational due to ongoing conflict. This is eerily reminiscent of the 1979 Volcker problem, which unleashed all sorts of economic havoc. This is oil-driven inflation that will seep into virtually every corner of the economy, except this time, the U.S. is burdened by a mountain of debt that makes Volcker's historical response, jacking up interest rates to a punishing 20%, utterly impossible. There is simply no way we could implement such a drastic measure given our current debt levels, so the Fed, once again, is locked in. They are boxed in completely. They cannot raise rates to crush inflation because the interest payments on the national debt would bankrupt the Treasury, and they cannot cut rates to save the bond market. Because cutting rates while inflation is accelerating would devastate the dollar and make inflation even worse. They are truly unequivocally trapped. This is precisely what I've been warning about for over a year, and the market is finally beginning to acknowledge this grim reality. Right now, Fed funds futures are pricing in a roughly 50% probability that the Fed's next move by December will be a rate hike, not a cut. Think about that for a second. But this is just one piece of the puzzle. The inflation, the trapped Fed, the oil shock, the squeezed paychecks, all of this should be hammering stocks. They should be plummeting, yet they are reacting to none of it. They are operating in a fantastical realm where none of this is happening. And that brings us to the loudest alarm bell of them all. Mid-roll segment ketone, IQ, and Troom sponsorships. Welcome to part 3. The stock market has become completely irrational. While the bond market is screaming bloody murder and signaling immense distress, the stock market is floating along at fresh all-time highs. This, in my professional opinion, is utterly insane because the underlying math driving this rally is genuinely stupid. We are currently pricing in a historic value, exploding extravaganza that would have to materialize at such a dizzying speed that it outpaces the looming bankruptcies. Yes, bankruptcies, we were talking about the massive infrastructure build-out required for AI data centers. It is looking increasingly unlikely by the day that the revenue from AI will hit before the wave of bankruptcy starts crashing down. Consider this. The Philadelphia Semiconductor Index, the SOX, is currently trading an astonishing 62% above its 200-day moving average. In plain English, semiconductor stocks have surged so far beyond their average price over the past 10 months that the gap is now the widest it has ever been in the entire history of the index. This is just bullish. It is a parabolic ascent that historically ends poorly. Furthermore, the Shiller-Cape ratio just crossed 40. If you are not familiar with this metric, you absolutely need to be, because it is a glaring, screaming alarm. In the 150-year history of the market, we have only ever crossed 40 to 1 in the Cape Index twice. Can you guess the dates? 1929, a familiar date, I hope signifying the start of the Great Depression, and 1999, right before the dot-com bust. These were two of the biggest market crashes we have ever witnessed. The first led to an 89% drawdown and the Great Depression. The second resulted in a 78% NASDAQ collapse that ushered in an entire lost decade for equities. There is no third example with a happy ending, because there was no third example until now. What Cape at 40 actually means, in simple terms, is that investors are currently paying $40 for every $1 of average inflation. Adjusted earnings the SP 500 has actually produced over the last decade. The long-run average, for context, is around 17. Every serious study of Cape as a forward indicator unequivocally states the same thing. At these elevated levels, the implied 10-year return for the SP is somewhere between 0 and negative. You are not being compensated to own stocks. You are quite possibly being charged for the privilege. You are likely to lose money. Bank of America's chief strategist isn't even comparing this current situation to the dot-com bubble anymore. He is drawing parallels to the Mississippi bubble of 1720, a speculative mania that ultimately wiped out the entire French economy. But wait, it gets even worse. The Magnificent Seven tech stocks now constitute roughly 30% of the entire U.S. stock market. The entire rally is precariously balanced on the backs of just 7 companies, and it is basically all fueled by AI. All of the perceived growth isn't just riding on a handful of companies, it is riding on one single massive technological bet. A bet that is entirely dependent on the kind of staggering infrastructure build-out that has historically led to massive wipeouts. I am talking about bankruptcies as far as the eye can see. We saw it with the railroads in the UK, and again with the railroads in the US. It happened once more with the telecoms during the build-out of the internet. When you have these enormous infrastructure outlays that require commensurate, exponential growth in revenues to follow, if that revenue doesn't materialize fast enough, it does mean the technology is bad, but it does mean a lot of people are going to go bankrupt. And the next generation of owners will be the ones to reap the benefits. That is precisely what we are staring at right now. If AI revenues do not start growing exponentially and fast, the entire market implodes. Smart money, the true professionals, can see this coming. Hedge funds just dump their tech exposure at the second fastest pace in a decade. Michael Burry, the legendary investor who accurately predicted the 2008 housing crash and inspired The Big Short, has loaded up on put options, betting heavily against semiconductor stocks. Meanwhile, retail investors, bless their optimistic hearts, are pouring money into tech ETFs at a record pace. This is the exact disturbing pattern we observed in 2000: institutions selling at the top and retail buying into the dream. One side of this market is going to be catastrophically wrong and will be left holding the bag. And the bond market, in no uncertain terms, is telling us that the wrong side of this equation is the stock market. Rising long-term yields, a collapsing safe haven premium in every major market, and 50% odds of a Fed rate hike are not the signals of an economy that supports record-high stock prices. These are the unmistakable signals of an economy in serious trouble. When the safe 30-year Treasury bond pays you a guaranteed 5% backed by the full faith and credit of the U.S. government, every rational investor on Earth is going to ask the same fundamental question. Why am I taking the immense risk of owning stocks in exchange for similar or even worse returns? When that question starts to resonate, capital begins to flee risky stocks and chase that guaranteed return. This outflow mechanically pulls down the entire stock market. Furthermore, every company that needs to refinance its debt, which is basically all of them, constantly is now going to be paying dramatically more in interest. This directly eats into the profits that are supposed to justify their current inflated stock prices. Rising long-term yields purely by mechanical forces lower what every single stock on the market is actually worth. So where does this leave us? We have 3 blaring alarm bells ringing off the hook, all at once in nearly every major economy on Earth, an unprecedented situation in modern financial history. The Fed has clearly lost control of the long end of the curve, inflation is back and it is accelerating, and the stock market is pricing in a fantasy that the bond market has already unequivocally stated it doesn't trust. The odds are extremely high that this ends with fireworks one way or another, but there are 2 primary paths forward for us. Path number 1. Yields miraculously come quickly back down, the Strait of Hormuz fully reopens, easing oil supply concerns. And everyone breathes a collective sigh of relief. People react positively, perhaps overly so, just to the good news, or, I suppose. The Fed could cut rates aggressively, but if they were to do that, cutting rates while inflation is accelerating, it would only crush the dollar, driving oil and food prices even higher. That would make the inflation problem exponentially worse and ultimately would tank the stock market anyway. So, barring a swift and unforeseen turnaround in global geopolitics that causes a sense of euphoria and an AI miracle that can truly catch up to expectations, you are looking at fireworks. Path 2. Bond yields either stay where they are or more likely go even higher. Capital continues its exodus from risky stocks, chasing the guaranteed 5% return on government bonds. Corporate refinancing costs skyrocket, eating deeply into earnings. The AI infrastructure bet, which is currently propping up 30% of the SP, starts to wobble, causing stocks to slam back down to earth in a sharp, painful correction. Once again, fireworks. There is no clear third path that avoids these fireworks. The everything keeps going up forever outcome that the stock market is apparently pricing in requires the bond market to be fundamentally wrong about the future. It also requires the 40-to-1